Hey everyone, it's Michael. Today I'm going to bring you a video. I'm going to tell you how to buy a home in coastal Orange County, 5, 6, 7, 8 million, without having to sell your other home first. Stay tuned. All right, we are here today with Jeff Bay. He's an independent mortgage broker. Worked with him extensively over the last couple of years, but specifically last year during 2021, we did two really, amazing outcomes for our clients. And we're going to sit down today. We're going to talk a little bit about mortgage banking, lending. We're going to talk about different types of deals that you offer or different types of structures that you have. And we're going to talk specifically about those two case studies in Crystal Cove, private money deals. But before we jump into that, maybe, give me a little bit about your background.
So I've been a broker for about 22 years now, 42 years old. I got started in the business real early. My mom was a broker. And so first year out of college, I processed for her every summer. And after a few years, money was good, really piqued my interest, decided to get licensed, and the rest is history.
So you say process, so doing all the back end paperwork?
Yeah, so she was a loan officer, she met the clients, she qualified them and whatnot, and I would handle all the paperwork. So, everything from taking applications by hand, having them faxed, make photocopies. Faxing documents to me, making photocopies or dropping off originals, making photocopies. So it was
You're telling everyone how old you are, basically.
Yeah.
That's okay then.
Yeah.
Hey, experience, wisdom, right?
Absolutely.
So, that's awesome. So independent, touch base or just kind of explain, because, a lot of people think they're going to go buy a house. Mm-hmm. I got to get a mortgage. I'm going to call whoever I have a checking account with, Wells Fargo, BofA, whoever it might be. But there's a lot of options for people, right? So, and then there's a lot of people who, if you're self-employed or, you have like a complicated, balance sheet, there's a lot of other ways to get financing. Right. So is that the mortgage broker benefit?
So the difference between like going to like a bank, like a Chase, BofA, Wells Fargo, and working with the broker, an independent mortgage broker, is that, the banks are going to have, their set of guidelines. They'll only do certain types of loans, very vanilla deals. Whereas a broker like me, we've got access to multiple investors. So, currently we're approved with like 30 different investors. And so each investor offers, a different type of product that may suit your clients over, a traditional bank. In most cases, for instance, your two clients, typical banks aren't going to lend, $6 million, within 1 week, so they can go buy a property and flip it. We have access to people like that.
Yeah, it's interesting because these two case studies that we'll call them, they were pretty similar, right? It was a client who wanted to buy a house. We found it off market. They really would have needed to sell their house first to be able to qualify, right? But you were able to come up with a really cool strategy of, they don't have to sell their home, get them private money, cross collateralize. We should probably explain some of this so that people understand. But let me finish real quickly. Without having to sell their residence first, they were able to borrow money effectively from you. Well, not you, but you were able to get them money to do the acquisition, and then sell their home subsequently thereafter. But it's really important. I want to make the case that it's really important, especially these off-market transactions. You don't have time, and as I think you were just about to touch on, a traditional bank, they need at least 30, maybe 45 days, especially since the pandemic, right? So, we were able to close in 8 or 10 days?
Yeah, we closed it pretty quick.
Yeah. It's complicated. Talk about processing. There was a lot of moving pieces. And look, buying and selling real estate is stressful for everyone, right? It's stressful for the seller, it's stressful for the buyer, it's stressful for everyone in between. But I think that, these two case studies we're going to talk about are the outcome was extraordinary. Both of them got great deals on these off-market properties. Both of them were able to, kind of work around the traditional financing methodology. So let's just pick one. Let's talk about the one that was in that like $5 million range.
Yeah.
And our client needed to sell her property. It wasn't going to happen quickly,
Right.
Right. It wasn't one of those like brand new white boxes that everybody wanted. So instead, you decided to do what? Get a bridge loan?
Yeah. So I think on that one, so you tied it up at like I think just over $5 million, right?
Yeah.
And then her current property, she was planning on selling it and using that money to purchase the new property. And she was going to go, with traditional financing, basically meaning that she could show her ability to repay, get a good loan, buy the house without having to get a bridge. But what happened was I think you decided that she could get more money for her house if she were to fix it up, right? Which put more time on the clock for us.
Right.
So the way we structured this deal was we found a local investor, someone out in Newport Coast, private money guy. We structured the deal. We did, I think, 80% LTV. So we put 20% down. And again, no income, no employment. I mean, this is all based off just the asset, the property.
Right.
So we did 20% down.
Which, let me touch on that real quickly. I mean, so if I'm an investor,
right.
I'm a high net worth person and I'm looking for alternative investments, and someone comes to me and says, I'll put 20% down on this Crystal Cove property,
right.
and you lend me 80%, right?
Yeah.
So my 80%, you feel so confident that asset, that Crystal Cove home is going to be a strong enough piece of collateral for you that it's like, doesn't really matter, how much money you make, because if something happens, I'm going to get this great house.
I mean, that is a little bit of the thought. Ideally, we don't want anyone to default because, we would like them to, make their payments and pay off the loan eventually. But yeah, you're right. If something were to happen, there's enough, room in there to, if we had to, foreclose and sell, the investor would get their money back. But
yeah.
Obviously, that's not what we're trying to do.
No.
But in this case, even 80% is not enough. Like typically, we like to see 30% down. We like to have more, the client to have more skin in the game. So in this case, because our client only had about $1 million, I think, on hand cash, the rest of her money was tied up in her current property. So we cross collateralized, right? Mm-hmm. Basically, we put a lien against the property for $1 million. So that way, whichever property sold first, the investor would get an additional $1 million to put down on the property. Mm-hmm. Does that make sense?
Yeah.
Okay.
Yeah, definitely. And then, so we talked a little bit about, it's easier, obviously, from a qualification standpoint. It's faster, so these are all the benefits. So what, there's got to be some. So what's the offset of that? Is it higher interest rate?
Yeah, so higher interest rate, cost up front. Typically a hard money deal or private money deal like this costs anywhere between 1 to 2.5 points upfront costs for the client. So in this case here, you're getting a loan for $3 million. It's going to cost about $60,000 in fees up front. Mm-hmm. The monthly interest rate's typically between 7 and 8.5%, and that's interest only monthly. Mm-hmm. A lot of times, we require a 3 or 6 month interest guarantee, meaning the client has to hold the property for at least that long. Mm-hmm. So that way we can, make sure that we make money for the investor. Mm-hmm. When you look at it though, I mean, like for this property, she really had to move quick on it, right?
Yeah.
And so she couldn't wait to sell her house. Otherwise, that property's gone. And, if she lost out on that property, obviously she wouldn't have had all the upside she has today on it.
Yeah, I think that's really important. In this market right now with virtually no inventory,
right.
Someone that wants to own a home in one of these communities in coastal Orange County, there's no choices. And
right.
so, she'd actually been looking for, we'd been looking for, God, it was over 2 years, mm-hmm. right? And so the one that popped up, and I knew it was the one. I said, whatever we got to do, whatever we have to do, we're going to have to do it so it doesn't slip away. And I think that's important in this environment currently in coastal Orange County, is that there's no inventory. So if you find the house that you love, you just got to So it's going to be a little bit more expensive, but that's over the long term. Plus, so that this is really a short-term financing mechanism.
Right.
The other house got sold, moved in, made a few improvements, goes to, either comes back to you and, does some traditional financing, refinances out at an attractive rate. So whatever that was up front. Plus, am I right or wrong? A lot of those hard expenses you can write off on your taxes.
Yeah, of course. Yeah.
All of it.
Yeah.
Yeah. So when you look at it that way, it's going to cost you up front, but you're going to get the house that you want.
Right.
You can write off those expenses. So at the end of the day, it's not really costing you that much.
Yeah,
right?
it's the cost of getting what you want, to be honest with you.
Yeah. So, we did 2 of those and they were pretty identical. It was unique that they were both in Crystal Cove, that, you know, both clients, you know, would have had to sell their original asset, right? Their original, their primary home. We've had deals also where we cross-collateralize, you know, investment properties. Some people have commercial real estate. So, I mean, it's a great tool. It's a great tool for people that, you know, want to jump on something and you know, because sometimes selling your primary house, if you've got to do stuff to it, I mean, even in this market, you know, you're talking about a minimum of, you know, 30, 60, 90 days, best case scenario. So
I think the unique thing with these two properties is that the buyers, investors did not have enough money to actually buy the property, even through like private money financing. But luckily they had equity in their properties, so they were able to cross collateralize those properties, you know, to get the deal done. And I think that's the unique thing with these two.
Yeah, I think that you know, back in the olden days, like you would just pull like a HELOC out of your, you know, you could access your equity much easier, much faster. But I think post like 2008, not that many banks are doing you know, HELOCs or home equity line of credit.
And again, time's a factor too, right? To get a HELOC might take 30, 45 days to get an appraisal. And
I mean, I heard that some banks are like 3 to 6 months on HELOCs just because like they're backed up. Because they're doing the purchase. You know, there's an order of priority. Right. It's like they're doing new purchases, refining clients. And I mean, are banks even wanting to do HELOCs?
So some banks are doing line of credits. They're not taking that long. More or less, if you have a current line of credit and you're trying to refinance a property where that line of credit's tied to and you want to subordinate it, keep it, that's taking anywhere between 2-3 months to subordinate. So you know, that's on the refinance side though.
Yeah, I mean, a lot of our clients in the ultra high end, you know, have the private banking relationships. And they give them just, you know, they'll give them a loan based on, you know, backed by their assets or, you know, just the relationship lending, so money's cheap still though. I mean, people, a lot of stuff going on in the news about, you know, the Fed, what the actions they're going to take. People are really hypersensitive on inflation right now. The 10-year has moved pretty significantly. So rates have already started to go up in the short term, but, you know, where do you see things going?
I mean, you know, we look at things day to day, especially when we deal with clients, because, you know, in a purchase transaction, for instance, if we open up escrow and they're happy with the current rate that we offer today, we typically lock the rate in. Like right now, we're not sitting on rates because, you know, we see rates going up. It's already known, right? The Fed's talked about it. You know, they anticipate they're going to do maybe 3, I think, rate hikes this year. First one coming at the end of the first quarter. So what we do know is that they're going to raise the rate to curb inflation. But, you know, what we don't know is if it's going to go, you know, 1/4 point, 1/2 point. Either way, you know, rates are going up, and they have been going up since the beginning of this year. So
it's funny when I look at the bond market. You know, as you know, I used to be a bond trader, and you know, the bond market right now. I mean, the bond market's a very smart, you know, indicator of what's about to happen, you can tell the market already priced in at least a 25 basis point hike. I mean, I think that there's no way they do 50 out of the gate. You know, it just doesn't. It doesn't.
That's if they want to really surprise.
Yeah. So I don't know, but you know, it's a conversation everyone's focused on. There's a lot of volatility in the stock market right now. You know, employment seems to be kind of an ongoing. It's like, you know, people aren't wanting to work these days, which is, you know, tough on a lot of sectors. I mean, the hospitality industry is, you know, suffering from it. But it's funny, on the way to work, I was talking with someone, with a client. I was saying, you know, over the last 2 years, the wealthy have just gotten real wealthy. Like, you know, our clients have doubled their money, doubled their businesses, you know, their properties have doubled, like everything's doubled, right? So it's, there's a lot of money out there chasing, especially in the real estate market, a lot of money chasing, you know, supply and demand. There's no product, right? So, well, listen, I think that, you know, explaining these alternative investment opportunities or alternative financing opportunities rather, is important, because a lot of people that I've talked to, you know, either are concerned about how do they move? Like, I don't want to sell my house because I don't know what I'm going to move to. This is a great case study of how we could, you know, acquire a property. You know, you could, I mean, there's a lot of different ways to skin the cat, but I wanted to talk about this so that we could get it out there so people could understand that, you know, you can buy a property even without selling your existing property. You know, there's a lot of moving parts, cost you a little bit of money up front, but at the end you get to, you know, peace of mind of not like sell your house, you don't know where you're going to go, right? So I like this structure, this financing tool, especially in this area for the types of clients that we deal with and the types of properties that we have.
Right.
Yeah.
No,
so we're really ecstatic to continue that relationship. And then I think we should move on to another segment where we can talk about the traditional financing that is probably more, because what we just discussed is probably for a very small subset of people, right? But there's still a lot of people out there that are trying to buy that $2 to $3 million home. It's an entry home in coastal Orange County that are W-2, have good credit scores. Maybe they can talk to their bank, but they want to talk to someone like you who has, like you said, 30 relationships, right?
Right. Yeah. Or they can't show income. Maybe they're self-employed. They make really good money, but they write everything off. That's very common with our type of clients. So we do have a lot of non-traditional stuff where we can do 12 months business bank statements, we do 1-year P&Ls. We even have loans where we don't have to have any employment, any income required at all. Just a decent credit score and cash, basically.
Okay, I'm gonna stop you there.
Yeah.
We're gonna wrap this for today, but we're gonna do another video to talk about that non-QM type lending, bank statement lending, which I think a lot of people will appeal to a lot of people. It's a much bigger audience, right? All right, well, thanks for your time today.
Appreciate it.
Yeah, absolutely. All right, so that's a wrap. So this is series 1, or video 1 of a series that we're gonna do to bring you information about, how do you buy a home? What type of mortgage products are out there? What should you be thinking about? Who should you be talking to? So hopefully, you enjoyed that. That was an overview of a couple case studies that we did at Crystal Cove from last year with non-traditional, private money financing. So don't forget, subscribe, leave comments, and look forward to the next video where we're going to talk about bank statement financing with Jeff Bay.